Welcome back to Retire Well. I'm Kristen Oakley here with the owner of Citizen Advisory Group, Kevin Bucher, and today's show is all about how to de-tax your retirement. If you're just joining us, we spent the time before the break talking about how most folks are headed into retirement with a potential tax hangover, and we know that success in retirement isn't about how much you have, it's about how much you get to keep. And you said it earlier, Kevin, you love helping clients keep more of their hard-earned money and not seeing it be frittered away to taxes, right?
Yeah, I mean, and it's mutually beneficial, right? Because the more money you have, the happier you're going to be in your plan, the more your assets are sustainable, the better that's all going to be. And that actually helps our firm as well. So it's a mutually beneficial win, yes.
For sure. Well, I know I teased this before the break, but you and the team of Citizen Advisory Group have created a very special resource that previously was only available to existing clients of Citizen Advisory Group, but we are going to make it available to you right now, completely complimentary to you. So there it is on the bottom of your screen. We invite you to visit mytaxbilltest.com. You can also get there by scanning that QR code, and we're actually going to walk you through today what you're going to be able to see when you visit that site. But before we do, I would love for you to share a little bit about what this is and why you've created it.
Yeah, I kind of teased this a little bit in the first segment that if you're not doing tax planning or your advisor's not helping you with tax planning, you're on what we would call the government plan for your taxes. And what this report is going to highlight what that outcome for you would look like if you stay with the government plan. And I will tell you, you will have sticker shock with what your long-term tax liability projects to be on that government plan.
For sure.
So it highlights what is your tax liability on the government plan and gives a complete opposite end of the spectrum outcome of, well, what if you were proactive today and took some maybe pretty radical steps to de-tax your whole entire retirement today? And I think that range gives people a pretty good understanding of we need to be proactive when it comes to our taxes. When you look at the government's plan for you, you will absolutely have sticker shock at how much tax liability you project to have over the course of your lifetime.
Yes, well, just like we need a detox plan to remove harmful toxins from our body, we need a detox plan for our retirement. So we want to walk you through now this incredible resource. Again, we invite you to pick out your smartphone. You can, if you're on your laptop, visit the site mytaxbilltest.com or scan that QR code, and we're going to walk you through what's going to happen when you visit this site. So the first thing you're going to see is this landing page, as you can see here on the screen. It's going to ask you for some very basic information. You're going to put in your name, you'll put in your email address, no strings attached. This is just so the report can be emailed to you after you input this information, your age, and then how much money you have saved up in tax-deferred accounts. Maybe it's a 401k, a 403b, a traditional IRA. Then you'll also notice there's two little areas at the bottom that you can play around with, two sliders. One is you can adjust the assumed tax liability. The other, on the right-hand side, you can play around with the assumed growth rate of that tax-deferred money. Then, once you click submit, boom, side by side, you're going to see the difference between the government's tax plan for you on the left if you do nothing versus how much less you could pay in taxes if you enact some of these tax saving strategies that we're talking about on today's show. So you'll see that right away, which is mind-blowing just to look at those two numbers, right, Kevin? But then you're also going to get a detailed report emailed to you. It's 4 pages long. This is just one of those pages where you can see the detailed breakdown. As you can see in this example, this person had $500,000 saved up in tax-deferred money. They were assuming a 22% tax liability, a 6% growth rate. And look at those bottom lines, Kevin, the difference between what the government's tax plan is for this person versus how much less they could pay in taxes. How is it that they would have to pay potentially even more in tax than what's in the current account value?
Yeah, so that's a shocking realization, right? And it's partly based on the growth rate assumption that you've put in there. But yeah, your assets are going to grow over time.
Right.
And when they're in tax-deferred accounts, every dollar you're earning is adding to that future tax liability. Compared to if we were able to reposition those same dollars into a tax-free account, your earnings and growth on that account are yours, and you're not splitting it and sharing it with the IRS.